Hi again. This is still Chapter 8. It's Lecture 3, and we're just going to talk about how are notes receivables accounted for. There's some terminology that you need to be aware of. Promissory note means that there's a written promise to pay a specified amount of money at a particular future date. Now, the principal is the amount of money that is being borrowed. And then the interest, obviously, is the interest. It's going to be the expense that the borrower is going to pay to the person who loaned it to him or to the company that loaned it to him. Interest period, this is the time, if it's like a 90-day note, then that would be the interest period, and then the interest rate, of course, you will be given that in the problems. Maturity value, this is the principal amount plus the interest. So if you have test questions and they're asking you maturity value, they're not wanting to know the interest. They're wanting to know the principal amount plus the interest. That's what's going to be due when this note matures. So we're going to take that information and go on over to the next page, and we have to identify the maturity date, and you would think this would be done in a simple way. But actually what happens is when we're have specified number of days rather than months, we literally have to go through and count these days to determine when is this going to be due. So in this instance, there's a 180-day note, and it is dated on February the 16th. So that means the day that the note begins. We do not count that day that it begins when it is issued. So on the 16th, what we do is we take the number of days in the month and we subtract that date that it was issued on. So 28 days in November minus the 16th is when it's issued. So that means that there's 12 days that we're going to receive interest for February. Now we're trying to get up to 180 because right here it says it's a 180-day note. And so we literally go through, and you need to have written down somewhere when you're taking a test on this or something, you want to have written down the number of days in each month if you don't know them automatically. But you'll notice we do March, April has 30, May 31, June. We're trying to get to this 180. So you just keep this little cumulative running total over here as you go through listing these. And then when you get to the number 180, that would be on August the 15th. So that is the due date for this note that had 180 days, and it was issued on February 16th. So it is due on August the 15th. Now, to compute the interest, here's the formula. You take the amount, the principal times the interest rate times the time. Now this time, this represents the prorated part of the year. Earlier it was 180 days. So we would take the principal times the interest rate times 180 days over, it can be expressed as 360 or 365. Obviously 365 is the actual number of days in a year. But for this book's purpose and for your homecoming, we're going to use 360 because it simply makes it easier as far as eliminating some of the rounding that's necessary for that odd ending number. So we're going to use 360. So if we come down here, let's see. It says when the interest period is stated in days, we sometimes compute the interest based on 360 rather than 365. So if we had a principal amount of $5,000, the interest is 12%, we would multiply that times 60 days over 360. If you don't put in this amount, you're not prorating it for the 60 days. If you just take 5,000 times 12%, that gives you the interest rate for the whole year. So you have to be sure and remember to put in the number of days over 360. I see this a lot of times on exams where students forget this part, and then it's wrong because what they've calculated is an entire year of interest. So remember to do your prorating here. Now, we have the journal entries. Once we calculate this interest amount and everything, then you can make your journal entries. Let's see, this one in particular, this is an end of the year, and they have calculated, this was for 3 months, I guess. Yeah, it earns 3 months interest for October, November, December. What we're doing here is it's called accruing. We're accruing the revenue that we have earned for those 3 months. So in this instance, 3 months over 12 months and then multiplied times this. So they have prorated that, and they're making the end of the year adjusting entry, accruing the interest. This interest revenue will go into the income statement. Interest revenue, or receivable rather, will remain on the balance sheet until the actual interest is received. Okay. This is showing us how much did they earn for 2016. Well, we'd already taken $15 for the first 3 months, and then the remaining 3 months is, or the remaining 9 months rather, is the $45. And so they go through, and when they make the journal entry here to show receipt of the cash, what they're doing is they're saying, well, the note receivable was for $1,000. Interest receivable for the prior year, that was $15. The interest revenue that they've earned for this year for these 9 months, it's $45. So you add this up, how much cash did they receive? $1,060. You might want to be sure and go through and look at those and make sure that you have an understanding of them, because you know that's important for this chapter. And then this is an example of, we have a notes receivable, sales receivable. We record, this is in July the 1st, or sales revenue rather, I'm sorry, on December 31st, and we're accruing the interest. And then once again, we're showing the journal entry when we receive the cash. What's causing this this journal entry right here, this accrual, is because we're going past a year in. And so we're having to create our financial statements. So you have this journal entry to show how much interest revenue you have earned in this year of 2015. Then you'll notice the rest of it is earned in 2016. Here in April the 1st, they have $100. Okay. Let's see, no, they had interest revenue there of $100. Okay, this is interest revenue right here of $50. This is how much they have earned for these 3 months. So this is showing the journal entry when they receive payment of this on April the 1st. Okay, these give you good examples here of what it is that you're trying to do. I just want to remind you, you want to use the number of days of 360 when you're writing your journal entries and determining your amounts and all. Hope this helped.